What sort of market environment, particularly with rising rates, are you thinking about preparing for the future?
Yeah, so great. Thanks, Taylor. It's great to be here. First, we've always had a flexible balance sheet. In 2009, we made money. It was our worst year, and every quarter we had a 7.9% ROE. So the history and the culture of the firm is always to be flexible and well capitalized, criticized maybe in the heat of top markets, but kind of appreciated in uncertain markets where we are today. Well, first, as equity markets are down, which was a headwind for our business, the interest rates, as they've gone up, the interest rate spreads went up, and we ended up not just with a record quarter, but our year end was this quarter a record year, even beating last year. So in a market that's uncertain, we have a diversified business. So we tend to perform well in all markets. And with our capital, we can make adjustments, or we can hold more cash or move cash or even deploy capital with opportunities. So it's in those kind of markets. The up markets are a lot more fun, but the tough markets we seem to even outperform more relatively.
Paul, talk to us about whether you're seeing those opportunities. Are you deploying more capital, or are you putting aside more cash?
Well, even going into the middle of this, Caroline, we did closed three acquisitions last year, and they were opportunistic. I think a little bit as the market started looking uncertain. We had three great teams join us, and certainly part of the story of this year. And we still have capital to be able to do more, but the capital gives us opportunity to have excess cash on our balance sheet, and now as cash kind of is running out of the financial system at a pace, we still have plenty of capital to not have to worry about it, keeping our balance sheet very flexible. We didn't lock in long-term rates and gave up earnings maybe during the peak cycle. But now, with our record earnings this quarter, that flexibility is paying off because we're getting the benefit of rising interest rates. So we continue to invest, we continue to be flexible, and we're not bound like some companies do in tougher markets to have to cut back on hiring, CapEx or other things. So we just have to keep prudently managing the business in these times.
So you don't have any plans right now to make any adjustments in that space with regards to headcount, CapEx, et cetera?
We do, and headcount, we're hiring. We've been hiring, we're growing, and so we need to hire. And, it's a tougher labor market, but we've been successful in that. And then obviously, as labor costs are going up, that's a little bit of a challenge. But our turnover is still very low compared to the industry.
With regards to hiring, attracting talent, has it made your job easier or harder with regards to your geographic location down south in Florida?
A little bit of both. Everyone in the world has seemed to want to have moved to Florida during the pandemic, and then when job markets opened up, a lot of people went to flexible work environments, which we were already going to. But what's the right pace of allowing flexible environment, getting people in the office? That changes by geography. We think that people need to be in at least a few days a week to team, to solve problems, to keep the culture, which is really important to us. On the other hand, the reality of the job market, we thought was always going to move to a flexible environment. We're making plans and starting before COVID, but COVID actually turned it into a remote environment overnight. So getting people back and the right schedules and the right flexibility has been a challenge, and something that's probably new to most people in my type of job.
You talk in your press release about three significant sort of bolt-on strategic acquisitions. When you think about expanding your business, how should investors be thinking about some of those acquisitions and the potential for future acquisitions going forward?
Yeah, so we're very focused on, first, they have to be cultural fits, because we just don't want to go through any impact to our culture, because it really is our biggest retention vehicle. Then there has to be a strategic reason, and third, there has to be at a fair price. You don't want to work, free or negatively for shareholders. So all three of them have different purposes strategically. Tri-State is a great bank who has a leading third-party SBL technology. Yeah. We are leaving it separately, and because it services a lot of other firms in our industry. But it is great at running capital and has a great team, so it gives us another funding source. Sumridge is an electronic corporate trading business in the bond business. and their technology is something we want to put against our whole fixed income business. And we bought it, I mean, it closed at the right time. The volatility, they thrive. And so they've been thriving the last few months.
On that note, very briefly, you're a man who thinks about talent. You've been at Korn Ferry, of course, as chairman and the like. But to that point on credit and liquidity, we were hearing from Bain Capital that this work from home culture has made liquidity very hard in the credit market, for example. Has anything been a ramification of working from home for you?
Has anything? I think just the communication and service people, because servicing our advisors and, people across the industry. But it hasn't really impacted, I think, the basic business and the liquidity or the capital or those kind of needs. And we're experiencing our third acquisition was Charles Stanley, a over 200-year-old firm in the UK that really gave us critical mass in the private client group space. We've been talking with them for 7 years before we closed, so we're patient, kind of, but they've been a great fit. So they've all had different strategic reasons, and I think, hopefully, you don't wish a downturn on our clients, our people, but if a downturn comes, we may have more opportunities for people we've been talking to for a long time. So.